Welcome to Mathematical Finance. Today we are diving into the fascinating world of currency swaps. Imagine you want to buy a house in Japan, but Japanese banks charge you exorbitant interest rates because you're a foreigner. What if you could borrow locally at a cheap rate and simply trade your loan with a Japanese business owner who needs your currency? This brilliant financial maneuver is exactly what we will explore today. Let us get started. Now that we have introduced the idea, let us define what a currency swap actually is. In international business, companies often need foreign currency to build factories or buy assets abroad. However, borrowing directly in a foreign country is expensive due to a lack of credit history. A currency swap solves this. It is a financial contract where two parties exchange the principal and interest payments of a loan in one currency for those in another. Unlike interest rate swaps, the principal amounts are physically exchanged at the very beginning and then swapped back at the end. Throughout the life of the loan, the parties also swap their regular interest payments, allowing both to save money. Before we move on to the mathematics, let us visualize how this physical exchange actually works. Look at the diagram on your screen. We have a US company and a European company. At the very top, you see the initial exchange. The US company gives US dollars to the European company and receives euros in return. In the middle, we see the periodic interest payments flowing back and forth throughout the life of the contract. Finally, at the bottom, the final exchange occurs. The original principal amounts are traded back, so each company can pay off its local bank. This visual perfectly captures the mutual benefit of the swap. Now that we understand the mechanics of a swap, how do we figure out what it is worth once it has started? One powerful way to value a currency swap is to think of it as a combination of two bonds. Remember, a bond is simply a formal promise to pay back borrowed money with interest. If you are receiving US dollars and paying euros, it is mathematically identical to owning a US dollar bond, which brings money in, while simultaneously owing a euro bond, which requires money to go out. By finding the difference between the present value of what you own and what you owe, you can determine the exact net value of the swap contract today. This concept leads us directly to our first valuation formula. The total value of the swap in your domestic currency is equal to the present value of the domestic bond minus the present value of the foreign bond, converted at the spot exchange rate. Let us break down the symbols. V is the total net value of the swap. B sub D is the present value of the domestic bond, representing the money you will receive. B sub F is the present value of the foreign bond, representing the money you owe. Finally, S naught is the spot exchange rate, which is today's price to trade the currencies. If the domestic bond value increases, the swap value goes up. If the foreign bond value or spot rate increases, the swap value goes down. To use our swap formula, we first need to calculate the present values of those individual bonds. We do this using continuous compounding, which shrinks future cash flows down to what they are worth today. In this formula, B is the total present value of the bond. The symbol C sub I represents the regular interest cash flows at specific times. P is the final principal amount returned at the end. The letter R is the continuous interest rate, and T is the time. The term e raised to the negative r times t is our discount factor. It mathematically reduces future money because a dollar tomorrow is worth less than a dollar today. An increase in the interest rate R will decrease the present value of the bond. Let us see this formula in action with a concrete example. A US company receives 5 million US dollars and pays 4 million euros every year, with exactly 1 year left. The final principal exchange is $50 million and 40 million euros. The US interest rate is 4%, the euro rate is 3%, and the spot rate is $1.20 per euro. We are asked to find the swap's value in US dollars. First, we calculate the domestic bond value. The company receives a 5 million interest payment plus the 50 million principal, totaling $55 million in 1 year. We discount this 55 million back to today using the US rate of 4%. This gives us a present value of 52.844 million US dollars. Continuing with our example, we now need to calculate the value of the foreign bond, which represents the money the US company owes. The company must pay 4 million euros in interest and 40 million euros in principal in exactly 1 year. This creates a total future debt of 44 million euros. We must discount this future debt back to today's value. Since this is a euro debt, we use the European continuous interest rate of 3%. We multiply the 44 million future euros by the discount factor e raised to the negative 0.03. This calculation gives us 42.698 million euros. This number represents the present day worth of the foreign bond portion of the swap. Now we bring back our main valuation formula to find the total net worth. We cannot simply subtract euros from dollars, so we must convert the euro debt into US dollars using the current spot exchange rate of 1.20. We multiply the 42.698 million euro debt by 1.20, which tells us the debt is currently worth 51.238 million US dollars. Finally, we subtract this converted debt from the $52.844 million we are receiving. This gives us a final value of 1.606 million US dollars. Because this number is positive, the swap is currently profitable for the US company. The assets they hold are worth more than the liabilities they owe. We have successfully valued the swap using bonds. But there is another equally valid way to look at it. Instead of bonds, we can view a currency swap as a series of forward contracts. A forward contract is simply an agreement to exchange currencies at a specific future date at a pre-agreed rate. By calculating what the exchange rate is mathematically expected to be in the future, we can convert our future foreign debt into our domestic currency ahead of time. Then we find the net future cash flow and discount that single net amount back to today's value. This method provides a different perspective, but will ultimately lead us to the exact same valuation. To use the forward contract method, we need the formula for the forward exchange rate. This formula calculates what the exchange rate should be in the future to prevent risk-free arbitrage profits. F0 is the forward exchange rate. S0 is the current spot exchange rate. The formula adjusts the spot rate based on the difference between the domestic interest rate, R sub D, and the foreign interest rate, R sub F, over the time period T. If the domestic interest rate is higher than the foreign rate, the forward rate will be higher than the spot rate. This mathematical adjustment ensures that no trader can make free money simply by borrowing in one currency and lending in another. Let us apply this forward contract method to the exact same swap from our previous example. We want to see if we get the same result. First, we calculate the forward exchange rate for 1 year from now. We plug in our spot rate of 1.20, our US domestic rate of 4%, and our European rate of 3%. The time period is exactly 1 year. We subtract the 3% from the 4%, giving us an exponent of 0.01. Multiplying 1.20 by e raised to the 0.01 gives us a forward exchange rate of 1.212 US dollars per euro. This is the rate the market expects in 1 year. Continuing with the forward method, we now calculate our net cash flow at the end of the year. We know we will receive exactly 55 million US dollars. However, we have to pay 44 million euros at that same time. We use our newly calculated forward rate of 1.212 to convert that 44 million euro debt into US dollars. Multiplying 44 by 1.212 shows that our future debt is equivalent to 53.328 million US dollars. We subtract this future debt from our $55 million future income. This leaves us with an expected net profit of 1.672 million US dollars in exactly 1 year. We are almost done. We have our expected future profit of 1.672 million US dollars. But we need to know the swap's value today. We must discount this future profit back to the present. We set up our final equation, taking the 1.672 million and discounting it using the US domestic interest rate of 4% for the 1-year period. We multiply 1.672 by our discount factor of 0.9608. This shrinks the future money down to its present-day equivalent, giving us a final calculated value of 1.606 million US dollars. Notice that this is the exact same answer we obtained using the bond valuation method. Both methods are perfectly valid and yield the same result. Now that we have used these formulas, let us understand why these contracts are so crucial in the real world. Currency swaps are absolutely vital for international business and global trade. Without them, companies expanding globally would be crushed by high borrowing costs in foreign countries where they have no credit history. Furthermore, currency swaps act as a massive shield against exchange rate risk. If a US company owes millions of euros and the euro suddenly becomes much more expensive, the company could go bankrupt. A currency swap locks in the exchange structure, protecting the company from wild, unexpected swings in the global currency markets. We have covered a lot of ground today, so let us summarize the most important ideas. First, a currency swap allows two parties to exchange principal and interest in different currencies, securing cheaper foreign debt for both. Second, we can value a swap by treating it as a combination of a domestic bond and a foreign bond, finding the difference in their present values. Finally, we can also value it as a series of forward contracts, which yields the exact same result. You now have the mathematical tools to understand and value these powerful financial instruments. Excellent work today.